welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you for joining. Please subscribe and comment if you like the content. It's how we choose what stocks to do next. This channel is dedicated to rational investing. That means that we hunt for the intrinsic value of a stock. That intrinsic value is based on cash flow. When we have an estimate of what we think the intrinsic value of the stock is, we compare that to the market price and we figure out if there's a difference between the two, and if that difference closes, how much return we can get on a stock. We look at every stock with 5 key attributes. That would be top-line revenue growth, earnings growth as defined by EBITDA, free cash flow growth, a solid balance sheet, and a well-priced stock. Those are our 5 key attributes that we look for. This is a special series. We're going to be looking at airline stocks. I've had a lot of comments, and certainly recently with the price come down, it's very interesting to see if there's an opportunity to step into one of these investments and make good money. So let's take a look. We're going to go through 5 airlines: Delta, Southwest, United, American, and JetBlue. And then I'm going to produce a 6th episode where I look at all of them as a collection and figure out if you're going to back a particular stock, which one would be the best given these ratios to choose. Please watch the entire series to get the context. I'll be going fast. And then in the summary sheet, I'm not going to go back to the detail, so I need you to have that context when you look at the summary. All right, here we go. Behind me is Delta. All right, Delta has revenue of $47 billion right there. Last fiscal year, a 10K ending 2019 of December. All right. Previously, they had $35 billion in 2011, and over that decade, they've grown at about 3%, which is slightly above inflation. Not stellar, but not flat. It's kind of very mediocre. Moving forward to the EBITDA, you can see EBITDA has actually grown much faster, growing at 20% annually over that decade, from 3.7 to $9 billion over the 10 years. That's fantastic. That means margin growth. That means Delta's doing what they need to do to get more margin out of every plane ticket. I like to see that. That's excellent. Let's go get an EBITDA calculation and look at the multiples. So pension and long-term debt. Airlines have a lot of lease obligations. Some of them have pension debt, and some of them obviously have long-term bonds. And you want to add all that together. Don't just choose long-term debt. They've signed long-term leases, which are obligations that they need to fulfill. So all of that's in here, and you look at 27 billion to 25 billion, that's actually come down. That's good to see. So I take the debt, the market cap would be share price times outstanding shares to get an enterprise value. In this channel, we don't look at a particular stock, we look at the stock price, we look at the enterprise as a whole to come up with the value of the entire business, and that's how we judge the company. So the enterprise value has gone from 35 billion to $63 billion. This far corner is our market metric for valuation, and you can see it's averaged 9 times EBITDA. You got a high of 16 and a low of 6.5. That's kind of the range that this airline stock has traded in the last decade. As of the end of 19, it currently sits at 9 times. We'll look at current price in the future. Another big thing we want to consider here is the debt ratio. Now, the debt ratio is going to be very important to these airline companies. We like to see under 3 times EBITDA on this channel, but certainly given what's going on recently in the market, I'd like to see even less than that if I could find it. And what you'll see in Delta's actually averaged 4.3, which is a little above where we like, but you'll notice recently it's 2.8. So it's come down from the high early in the decade to a much more reasonable 2.8 times EBITDA currently, at least at the end of fiscal 19. All right, let's take a look at cash flow for Delta. Cash flow for Delta starts at $2.8 billion and has grown to $4.8 billion. That's fantastic. That's a 13% annual growth over the decade. That is in line with the EBITDA growth that we have seen, which is a great hallmark for a solid investment. You'll see CapEx here. CapEx is intensive, right? They're airline companies, so they're buying airplanes, which are very expensive. And you like to see this gap is actually positive between the free cash flow from operations and the CapEx, meaning they could afford all their CapEx in one single year, which is a great sign. They don't have to borrow that much. So they're making positive margin here after reinvesting for their business. You've got the debt payments largely negative. That corresponds to what we saw with the decrease in overall debt over the decade. Recently it's positive. Share count outstanding, this is interesting. They have repurchased shares over the time to the tune of 22%. What does that mean? That means if you owned a share of stock a decade ago and over time they have purchased and canceled shares that are outstanding, that means your one share as a percentage of ownership grows. So you start the business owning 1%, and over time with this reduction in shares you might own 1.2%, 1.1%, whatever it is. That means that this cash flow here has you have a greater claim on it, and it's one of the best benefits of long-term investing is your percentage growing over time. It's often overlooked. It's something that long-term investors need to look into. Share price gives me a free cash flow per share, largely positive, a few years that were negative, and then if I go all the way to the end, I get a yield and a growth rate. Yield of 3.4, which is moderate. Growth rate is negative. I think that's just really all over the place, largely for the buying down of debt that you saw earlier in the decade. But the yield is good. Free cash flow growth is solid, and we saw the solid EBITDA. All right, so now let's forecast this forward. What we're going to do is, because of the downturn and the change in the economy, I've taken a forecast in general and applied the same forecast to all 5 of these companies, so the growth doesn't impact the value of the business going forward. We're going to pick one of the 5 stocks. So I wanted the growth to be the same on all 5 and see how does that affect the long-term valuation. So what we're going to do is we're going to pick up the free cash flow growth in the future. I'm saying that because to get out of this bailout, to get out of this issue, they're going to have to take on a lot of debt. And they're going to get bailed out by the government. Those are assumptions we're going to make. That's going to be zero cash flows. They have to scramble to buy down debt as they struggle to produce positive earnings based on lower sales revenue. You're going to get nothing. But then it's going to pick up with the average free cash flow that they've experienced the last 3 years, and I'm going to grow it at a very mild 5%. To get an $80 price tag in 10 years for Delta, this 80 is based on an average yield, average free cash flow yield for the industry. And I'm just dividing 3.99 free cash flow per share divided by the average yield gives me 80. Let's look at EBITDA. All right, behind me is the EBITDA for Delta. We're going to look at the valuation here. I'm picking up of $8.3 billion of EBITDA. Now that's the average of the last 3 years. Obviously 2020 is a terrible year. And I don't expect any of these numbers to happen, but what I'm trying to do is forecast 10 years from now. So I'm picking this number up and I'm growing it at a very small rate over time to give me a long-term EBITDA for the industry to come up with a value. Long-term EBITDA for the stock to come up with a value. So in these early years, absolutely expect carnage. We don't know what that's going to look like or what that's going to do to the stock. But long term, as it recovers, it should be able to both be profitable and hopefully even gain market share. So what I'm doing is I'm taking $12 billion of EBITDA and I'm applying an average market multiple to this based on the airline industry specifically. And I get $98 billion of market cap. I pull off debt, which I think is an average, and I come up with a market cap of $57 billion. Divide by the outstanding shares. Here I've added 10% to the outstanding shares for dilution that will most likely happen as a result of bailouts or leveraged loans they're going to have to take in order to get through this crisis. And I get an $80 stock price. Just happens to be coincidentally extremely close to the free cash flow valuation. Let's push this forward and look at the stock price return. All right, so the stock price is $22.41 right now. I've got an estimate of $80, splitting the two different valuations. I've got free cash flow valuation, and I got an enterprise multiple valuation. I'm averaging the two to come up with an $80 valuation. What does that look like on an IRR basis? Here you go, $22 is our entrance point where we buy the stock at $22.41. I get zero cash flow for 3 years, just assuming that every dollar they're able to scrape together goes to pay down debt service, employees, reinvest in CapEx. Shareholders get none of it. But going forward over the long term, share value, cash flow will return, assuming they're in business. And that return, again, I've used average last 3 years, grown it over time, and we've got our long-term valuation target of $80. This is really interesting. If I buy it at 22, I get a little bit of cash flow and I sell it at 84. That return over the decade is 21%, which is a very high return, certainly one of the highest we've seen here in this channel. On a cash-on-cash basis, you're basically 5 times your money if the company survives. So this is a strong return profile. I think really this behind me shows that it's a math exercise. I'm taking numbers, I'm growing them, I'm discounting them to come up with valuations. The real question is, do you believe the airline will be in existence in the next year? If it is, I think you've got a higher likelihood of these numbers. If it isn't, you have a problem, the stock could go to zero. So any of these reviews that we're going to look at, we're going to consider kind of a binary option. Either the stock bankrupts or you hit your target. That's the way we're going to look at this. Delta seems like pretty solid. We're going to see how it stacks up to the rest. Please watch the next video. My name is Cameron Stewart. Thank you very much for watching Value Investing.